The title of this video might make some people scratch their head. How can selling shares of a stock be better than taking a dividend in retirement? Well, let me show you. Dividend investing is incredibly popular for the retirement community. Retirees face the challenge of looking at a large sum of money they've accumulated over their life and wondering, how do you turn that sum of money into income or an income stream? And dividends seem like a no-brainer. A dividend stock is pretty simple to understand on the surface. You own a given stock like AT&T. AT&T earns profits each year and then pays out a portion of those profits to investors in the form of a dividend. That dividend is income for investors, and hopefully the company's stock appreciates in conjunction. And then voila, it seems we have solved the income problem for retirees. So what in the world could be the issue with dividend investing? And why would someone like Warren Buffett, often thought of as the greatest investor in the world, why would he be opposed to dividends? Why has his company, Berkshire Hathaway, never paid a dividend? Well, I explain why in this video and show 3 reasons why dividend investing isn't as preferred as selling shares of a stock in order to fund your retirement. But first, we all need to have a base understanding of dividends. In terms of valuing a company, dividends are irrelevant. They neither make a company more valuable or less valuable. This is referred to as dividend irrelevance theory and was first pioneered by Merton Miller and Franco Modigliani, who later won the Nobel Prize for their work alongside other research. Here's what happens when you have a dividend-paying stock. Say a company is worth $100 per share and they pay out a $2 per share dividend. Once that dividend is paid out, you will now have a stock worth $98 and a dividend worth $2. You don't receive any magical return. The dividend you are paid out lowers the value of the stock. And so we see the dividend as well irrelevant. And in reality, this theory argues the dividend actually may be worse than irrelevant, because what happens if that company has a money press where they can put $1 in and receive $2 back in, let's say, 1 year's time? In this case, you wouldn't want that company's profits. You would want them to reinvest back into that money press, back up the truck, if you will. But despite retirees understanding or misunderstanding the relevance of dividends, there's still an attachment to dividend investing. It's still quite intriguing for many investors, and I hope to show reasons why it shouldn't be. Reason number 1 that I hear is that receiving dividends is safer than selling stock. When you receive a dividend, you don't have to sell shares from a stock. If I sell shares in place of a dividend, well, then I have fewer shares. But here's the thing, you don't live on shares in retirement, you live on wealth. And shares have no correlation to wealth. For instance, imagine we have a pizza. I cut this pizza into 4 slices. I have 4 shares. I still have just 1 pizza, however. If I cut another 2 lines, now I have 8 shares of this pizza, but is 8 shares more valuable than 4 shares? And so that pizza will satiate me in the same way, whether it's 8 shares, 4 shares, or it's just 1 whole pizza. But yet this is an argument made in favor of dividend investing versus selling shares. Let's jump out of this pizza example and move towards talking within the context of a dividend. We have 500 shares of a $100 stock for $50,000 of wealth. This company pays out a $2 dividend, and now we have 500 shares of a $98 stock, and now we have $1,000 in the form of a dividend. If we consume that dividend, we now have 100 shares, but we still have less wealth. If we reinvest that dividend, we arrive at the same point where we started. We have the same wealth, but now we have more shares. But again, wealth matters. So again, we see the dividend is irrelevant in terms of overall wealth. But one of the biggest objections I receive in favor of dividends is that it's a behavioral hack. You know that dividends don't add value to your portfolio, but you know that spending dividend income is a safe way to spend from stocks. And look, there is some truth to this. As you can see on the screen, even when the market loses value, dividend yields frequently adjust, where the raw dividend, the dollar value you receive, is somewhat stable. Therefore, it seems that spending only the dividend is a psychological hack that you can use to spend from stocks prudently through even volatile markets. But generally, when I think of a hack, I think about something that adds value either quantitatively or qualitatively. In my experiences with retirees, however, I see dividend investing actually subtract more value than it often adds. Here's a clear example when we talk about spending in retirement. Say you were going to own the S&P 500 and spend the dividend yield for income. Now, many of us are familiar with the 4% rule. If you have a balanced allocation of stocks and bonds, Historically, you could have started by spending 4% of your portfolio and inflation adjust that through time, and that would be thought of as a safe withdrawal rate. If instead you had money in stocks and only spend the dividend yield, look at the gap in spending capacity. By spending just the dividend yield, you end up spending significantly less. Now, your portfolio will likely grow if you just spend the dividend yield, but this is a bug, not a feature for most retirees. Say you retire in 2005 and decide to just live off the dividend yield. Now, you start by spending far less than you otherwise could from the portfolio shown on the screen. This means you either agree to spend less than your capacity, or you end up working longer to accumulate more so that the dividend income can meet your spending goal. Both of these avenues are inefficient and cost you as a retiree. Now, fast forward to 2020, and because you've been spending less than you should, your $1 million portfolio has grown to $2.5 million, which means your dividend income has grown as well. It's grown from $17,600 to now $39,500. So now you're 15 years into retirement. You're still spending less than you could have, and although your income has grown through time, it's growing as you're going to be using it less. You would have used that income in a lot more beneficial ways when you first retired when you were, let's say, 65 and healthier than when you are now 80 years old. Using dividends to plan for retirement income is wildly inefficient. But many will argue that you shouldn't use the S&P 500 in dividend investing. You should use higher dividend paying stocks. Well, over the last 20 to 30 years, this would have cost you. Dividend paying stocks would have underperformed non-dividend paying stocks over the last 30 years by around 3% in figure 1 on the screen. Equity funds that have a lower dividend yield would have outperformed those that have a higher dividend yield over a 20-year period ending in 2006. And in general, orienting towards dividend stocks only leaves you less diversified because it forces you to invest primarily in value-oriented companies and leave out growth companies, tech companies, and companies in that category. And so I'm all for using behavioral hacks in retirement planning. Sometimes our brains are our own worst enemies. But I want to use behavioral hacks that at the very least don't hurt the efficiency of our planning. Here's an example of a hack that almost no one would agree to. What if you adhered to a rule of checking your investment portfolio only once per year? We know that most bad decisions come from emotional, short-term decision making, and we know the market is highly unpredictable in the short term. Checking your portfolio less is proven to lead towards better decision making. If you're interested in a behavioral hack, this is far more compelling than using dividends and doesn't cost you if you're a long-term investor. Next, know that dividends aren't completely irrelevant depending on the type of account they're located in. For instance, in a taxable account, selling stock is greatly preferred, and you can see why with the example on the screen. Say you have a portfolio of $1 million with $500,000 of cost basis. If you sell a stock, we'll assume half of it is gains and half of it is cost basis. Well, your tax obligation at a 15% tax rate is only $2,250, which means you receive a cash flow of $27,750. If you take a 3% dividend instead, all of that dividend is taxable at 15%, which means you double that tax bill and end up with less income after taxes. Now, in both scenarios, you have the same amount of wealth left at the end, but the dividend leaves you with less income. So you either need to accept less income or sell more stock anyway. Either way, you have less wealth taking the dividend versus selling stock. And we call this dividend tax drag. The further we project out the cost of dividend drag, the less wealth you have. The higher the dividend yield, the less efficiency you have. And this is assuming you end up fully liquidating this taxable account in retirement. If you pass away and your heirs get a step up in basis, the cost of dividend tax drag is even higher. And so understand that I don't hate dividends. I don't think you should seek dividends nor avoid a stock just because it pays a dividend. Dividends are mostly irrelevant in stock valuation and are inefficient in retirement planning. They're an inefficient way of determining your spending capacity, and in terms of taxes, they have a substantial cost if held in a taxable account. Given this, a retiree should prefer selling stock over a dividend if they have a choice. This way, they have far more control. Now, in the goal of empowering retirees, I want you to be aware of just how much you can afford to spend in retirement. Often it's more than a basic dividend yield and even more than the 4% rule. Watch this video to learn more and find out just how much you can spend in your retirement. Thanks for watching, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.